What is a private placement of securities? Have you ever wondered how companies raise money without going through the traditional public markets? One method they use is called a private placement of securities. This approach allows companies to sell stocks, bonds, or other financial instruments directly to a select group of investors. Instead of offering these securities to the general public, they target a limited number of chosen individuals or institutions. Typically, the investors in these private placements are institutional entities like banks, credit unions, pension funds, mutual funds, and insurance companies. They may also include high-net-worth individuals who meet specific financial criteria, often known as accredited investors. This means they have a certain level of income or net worth that qualifies them to invest in these types of offerings. One key feature of private placements is that they are non-public offerings. This means the securities are not broadly advertised or sold to everyone. Instead, they are sold privately, which helps maintain confidentiality about the company's financial details and strategic plans. This is particularly important for privately held businesses that want to keep sensitive information under wraps. Another important aspect is that private placements are exempt from the usual registration requirements with the Securities and Exchange Commission. This exemption reduces the regulatory burdens and disclosure obligations for the company issuing the securities. Because of this, private placements can proceed faster and at lower costs compared to public offerings. However, this lack of regulation also comes with risks. Since private placements are less scrutinized, they can be a breeding ground for fraud and investment scams. It is vital for banks and credit unions to conduct thorough due diligence when investing in or facilitating these transactions. This includes verifying the legitimacy of the issuer and ensuring that all investors meet the necessary qualifications. For banks and credit unions, private placements can be an attractive option. They provide a way to invest in potentially lucrative securities without the complexities of public markets. Additionally, for those acting as issuers, private placements offer a means to raise long-term capital efficiently while diversifying funding sources beyond traditional loans. In summary, a private placement of securities is a targeted sale of financial instruments to a select group of qualified investors. It offers advantages like cost savings and speed while requiring careful oversight to prevent fraud and ensure compliance with regulations. Understanding this process is essential for anyone involved in personal finance or investment strategies.